All right, good evening, everybody. Thank you for attending on this on such short notice on the Christmas month of Christmas. So I hope everybody's in good spirits. We want to call the meeting to order. Time is 6:12 p.m. on Thursday, December 5th. So do a roll call if I can. Trustee Steve. Present. Trustee Brown.
Present.
And Trustee House is present. We're going to stand for Pledge of Allegiance. Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Okay, and if I can ask Elder Creighton, would you mind leading us in a prayer, please?
We ask, oh God, that you be in attendance in this meeting, that you lead in God every statement that's made, and that Dolton will be a better place for all of us. In Jesus' name. Amen.
Okay, so on here we have one agenda item that we will talk about. As we did not have a finance committee meeting last month, I would say that any of the normal reporting and things, if somebody has an inquiry or would like, please feel free to give me a call, text message, email. Phone number 708-625-1105, and I can provide any of the financial reports that we did not get. I'll slow down again. 708-625-1105 for anybody that would like the financial reports that we did not have last month because we did not have a monthly meeting. Or email is jhouse@vodolton.org. We did this one because there was a recommendation that came in regarding our taxes, and I'm going to slow down a little. Every year, the village is required that we state, and I'll ask Kasperic if they can to correct me if I'm stating this incorrectly. We are required to state to the public whether there's a tax increase or no increase. We must let the county know before the end of the year what our requested tax amount is. And if there's no increase, we still have to state it. If there is an increase, depending on the percentage increase, we must have a public hearing. Now, based on this proposal, there would not be an increase to our operating levy. There would be an increase to the loss and cost based on the proposal, which is what the Finance Committee is here to discuss, as well as the community. We want to be able to get everybody's feedback, and because it happened, because we're discussing this in December, we want to make sure that we have as much discussion. There was some question as to why this happened during this time frame. We do within the village have a lot of different moving parts. Kasperic has been acting as our finance consultant for this year, where last year we had a finance manager who may have pushed this a little bit further. So there's been a little bit of identifying roles. So I said that I will take that within the finance committee. It may be something that we should have looked at sooner, but we want to make sure we have the conversation now. So I will apologize for the timing and the notice, but we want to make sure that the community has an opportunity to be heard. This is the best crowd that I've seen for a finance committee meeting, so I'm going to bask in this moment for a moment. But having said that, we are going to move forward with the one item. We're going to do a slight departure. We're going to do from our norm in a sense of we will ask John Kasperic as our finance consultant as well as CPA advisor to speak on the tax ordinance. We will take questions initially from the finance committee, but in lieu of the citizens address, after the finance committee sends out the questions, instead of asking John to take a seat just for citizens address, we will see if we can identify somebody with a microphone that can bring the microphone to a resident and ask questions as well of Mr. Kasperic if there's things that the finance committee did not ask. My hope is that we will summarize most items or most things of contention so that the questions can be as to the point and succinct as possible, and we can get out of here at a reasonable hour. But that being said, this is a big issue, so we want to make sure that everybody's heard. With that, I'm going to ask Mr. Kasparik if you can come on up. I'll give a quick, come up here, and I'll give a quick overview of my understanding of it, and then please elaborate if I'm missing something, and then I'll ask the committee for questions. Okay, so my understanding, operating levy, where there's no proposed increase. On the loss and costs levy, the proposal has a 6% increase, which will be used to help to make sure that our fire and police pensions remain adequately funded. Right now we're doing well, but we want to make sure that we do not fall behind. Am I summarizing that correct?
So far, yes.
Oh, I see, reading helps. If you want to add anything to that, please do, and then I'll ask for questions from the Finance Committee.
Good evening, everyone. My name is John Kasparik, and I've been working as a financial consultant here in the village of Dolton. Along with me is Chris, who is really here more on the day-to-day activity of the village. Last Monday was the first time it was presented to not only the board but to the public on the tax levy. I prepare tax levies for a number of municipalities and school districts, park districts, so it's not something I'm not unfamiliar with. With Dolton, I had some conversations with two of the board members here via the phone just to get a feel on where I should put this levy so that it could be presented. And in light of what I also feel when I look at the tax rates of the village of Dolton, which is quite similar to tax rates throughout the entire south suburbs, we have some very high tax rates, which makes our housing as well as commercial property rather expensive. So the more we raise taxes, the worse it gets then, as far as not only the taxes going up, but then maybe businesses not paying, residential not paying. So last year, I'm just going to go through a little bit of an in-depth recap. Last year, the tax levy for the operating funds was $10,334,415. The operating funds are made up of your general fund, which was $6,076,000 and change. We have a tort liability to the city of Chicago. That's $1,368,000. So within the general fund, there's $7,444,000 levied in taxes last year. In addition, you have a police pension fund, a fire pension fund. They are regulated by the compiled statutes of Illinois. Within those statutes, there's a requirement that local municipalities that have their own police and fire pension fund, not through SLEP or IMRF, that they need to fund them. They get actuarial valuations. Actuaries come in, they project out what are the needed contributions, and then the local municipalities are supposed to levy those dollar amounts. If the dollar amounts collected are not sufficient, there's opportunities for the pension boards under their fiduciary responsibility to request what they call intercept payments from the state comptroller's office, which I believe was discussed on Monday as well by the attorney. They don't have to take action through the village board. They can just go directly to the county, or excuse me, to the state and intercept the sales taxes or the income taxes. So it isn't like if we don't levy for the taxes, we're getting away with something. They'll just get it from another source. Being that we want to make sure we don't have that problem or put the trustees of the pension funds in a precarious situation, the board here, and I've been looking at them over the past years, especially the last couple of years, they've taken a very active role. Yes, the taxes of the village have gone up, but it's to fund those pension funds. I mean, you hear a lot about the state of Illinois and their crisis. We are not in that crisis. The police pension fund, as of last year, I believe, was funded at approximately 59%, and the fire pension fund was funded at about 55%. Considering we have till 2040 to hit 90%, we're on a good target. So Dolton does not have to be looked at as not funding their pensions well. Believe me, there are other municipalities that are much, much worse than we are in funding their pensions. So with that, last year, the police pension fund had extended $1,824,000, the fire pension fund $1,065,000. Add those to the operating levies of the corporate fund, that brings you to the $10,334,415. Now, under the Illinois compiled statutes, there's what they call the truth in taxation. Truth in taxation requires that all taxing bodies, not just municipalities, but all taxing bodies must announce their tax levy 20 days before they pass. They can just say what the dollar amount is. They could do it they do them in many different ways with the taxing bodies that I deal with, because there is no prescribed rule other than saying what is going to be our next year's levy. And so the levy was announced that for the operating levies. Let me keep my train of thought. The truth in taxation law only relates to the operating levies. It does not relate to the debt service levies. It's important to understand, because your tax bill, when you look at it, is not just the operating levies, it's the operating levies plus your debt service levies. So when you look at the truth in taxation, they exclude debt service. Part of the reason I believe that it's excluded is because the debt service levies are set at the time the bonds are issued. It's the only way you're going to sell bonds. No one's going to wait for a governmental entity to decide if they're going to fund the bonds. Nobody's going to buy our bonds. So the promise to levy is already established at the ordinance. When the bonds are issued, they're automatically set in place. So no taxing bodies, as long as they're being GO bonds and they're going on a tax levy, have to pass a levy again for their bonds. So we don't have to worry about the bonds. The county's already got those numbers, and they will go ahead and add accordingly. So the truth in taxation deals with the operating levies, and what the law says, besides the 20-day notice, if you're 5% or more, you have to have a public hearing. Now, of course, you can have a public hearing and the board could still raise it over 5%, but the point of the law is to make the public aware if a tax levy is going to go up 5% or more, that they have to have a public hearing. And again, it's only related to the operating levies. The proposal that I had come up with in discussions with a couple of the trustees, I recommended that we keep the operating levies at 0% increase. In other words, the extended levies would be, the levy request for this year would be the same as they were extended last year. So the numbers that I read for you for the corporate, the Tort of Chicago, police and fire would still be the same dollar amounts. The debt service levies, I like to always include those in the total levy picture for the public as well as for the elected officials, because it is a part of your tax bill. So while it's not required by truth in taxation, it really gives a more complete picture of what's going to happen with your tax bills. So last year, the bonds extended following the amortization schedules was $4,838,000 and change. This year, the amortization schedule on the bonds, the principal and interest, will be $5,020,841. Now, it's something, again, as I told you, that's already set. That's not to be voted on by the board. That will increase the levy by $182,000. If you look at just that as an increase without the loss and cost being addressed yet, which we will in a minute, that creates an overall increase of 1.2% on the levy. With a zero operating increase and then the debt service going up, that will collectively go up 1.2%. Now, currently, the village last year had a 14% loss in cost, and for those that were here on Monday, I kind of went into that. Loss in cost is related to what are our levy actual collections. There's two things that impact collections. Once the tax bills go out, property owners have a decision whether they want to pay the tax bills or not. Obviously, if they don't pay the tax bills, they have the opportunity to lose their property. The second one that also affects our collections is refunds. When any property tax owner petitions the courts, they call it PTAB, property tax, and I forget the balance of the acronym, but anyway, PTABs typically are done by businesses. They basically pay their real estate taxes and then they fight them in court. Oftentimes it could be 2, 3, 4, 5 years before they're settled. And when a court settles, it's typically something between what the county, because the county handles all this. We do not handle, no municipalities handle, or governmental entities actually handle that process, because it's the county that levies the taxes. So if anybody's going to protest their taxes, they protest their taxes through Cook County, and then through the assessor's office, to be specific, and then the Property Tax Appeals Board, and then through the courts. When PTABs are settled, and depending on the size of the taxing body, whatever the county, or excuse me, whatever the courts determine what should be the fair market value, which will typically be less than what was actually assessed at the time, is going to develop into a tax refund, and it'll be multi-years of refunds. The county does not set up reserves for refunds, so therefore they take them out of our current collections. So that number will never be able to project, because we never know when the courts are going to settle. I've seen PTABs go on for 5-6 years, and unfortunately, when they go that long, when they do settle, that means the 5 years forward from the year that they first went back to, say, for example, 14, and it means all the years moving forward have to be adjusted, because now they're going to have a lower fair market value on property, which means their property taxes would have been lower, which means then they're entitled to refunds. And not just from the village, but from every single taxing body that's listed on your bill. So if you ever take the time to look at and I'm sure we all do, look at the second installment of the bill. The first installment's automatically set at 55% of your last year's tax bill. For any of you who ever want to go on your county website, if you want to pay early, it's already there for Cook County to allow people to pay their next year's bill. But the second bill is the one that actually breaks down what each taxing body on your tax bill is requesting, and that's what creates your tax rate. You'll be able to see a comparison of what was the bills last year to this year. And so on the second bill is when you'll see any increases in taxes, because the first installment, like I said, is 55% of last year. When we get our collections, and I did the report for the trustees and the mayor, well, for the whole village board, our collections for 2018 as of October 31st were just under 79%. That means that 21% of the real estate taxes were not remitted to the village. And that could be a combination of people not paying, which will be the bigger percentage. When I say people, it could be businesses, industrial, commercial, residential, and then the refunds, because those refunds will also impact our overall collections. Putting in perspective, last year at the same time, when we were collecting 17 taxes collected in 18, we're always a year in arrears. We're doing 19 taxes that are going to be collected in 20. When we did the prior year, we were at 85% collection. So as you can see, the loss and costs are, well, what I'm saying is that we collected 85% of the 2017 levy, and this year on the 18 levy, we're at 78%. So that shorts us. That's when I say us, I mean the village. The village then does not have enough money to equal its contributions to the police and fire pension funds, but more importantly, we don't have the money to make the debt service. So what ends up happening is we have to use general funds to make up that difference. Those same general funds, such as sales tax or income tax, which is used to operate this city, to pay for the public safety, to pay for the public works and so forth, because we do not want to default on our bonds. And I make sure that when I work with any of my governmental entities, we make our bond payments, because that's extremely important. It's extremely important for the whole, not just for us, but for the entire region, because what one municipality does could impact others, because they look at us as a region when you're in the investing community. With that being said, and seeing that the tax levies are collection rates are dropping now, there could be late payers, and that will happen for sure. I would anticipate that number will not be at 78% or 79% next year. I'm sure people will be paying their taxes even if they're paying them late. But what I suggested to the board, instead of passing on a 14% loss in cost like we did last year, and looking at the numbers and looking at how well we have funded the pensions and where we're at with money going into the pension funds, or at least the levies, that I recommended that the operating levies be zero. However, I still suggested that we drop the 14% loss in cost and reduce it to 6% for the police and fire pension funds, and another 6% for the debt service funds. those percentages, when you take them to the overall levy, would take that increase from 1.2 to 3.09%. So it does increase your overall levy to add the loss and cost. Again, this is given the complete picture. Truth in taxation does not require that loss and cost has to be discussed because it's outside of the law. However, again, this is giving to the board the full opportunity to see what the bill would look like. Now, the trustees asked, and I tracked down a couple of, Chris got a couple of property tax bills, second installment, to give you an idea what might that increase entail. So I have a property tax bill, and I don't know if it's the normal bill or not of the homeowners of the Village of Dolton. This bill is about $4,700. A 3.09% increase would be $39.53, because the 3.09 is not on the whole bill. This bill is made up of, as I said, numerous taxing bodies. You have the South Cook Mosquito Abatement in Harvey, Metro Water Reclamation, Dolton Public Library, Dolton Park District, South Suburban College 510, Thornton High School District 205, Dolton Riverdale School District 148, Village of Dolton, Thornton Township Road, General Assistance Town, and then you got the county taxes, Forest Preserve, Cook County Public Safety, Cook County Health Facilities. That creates the total $4,700 bill. Dalton's portion of that bill on this particular one is $1,279. So that apparently comes out to about 25% as I look at the math. So that would mean the village's bill is approximately 25% of the total bill of real estate taxes that you're paying. So if you took the 3.09% against that $1,279, that comes out to a $39.53 increase. There was another bill, this is on a parcel of property, which may not be the norm, of $12,000. That $10,785 total bill, of which
John, if I can interject a little bit, because it's a lot of numbers.
Okay.
So, because I want to kind of get us on summarily, because I think as the residents are asking the question, or if the board is asking, some of the information we may get will kind of expounded on in that scenario.
Fine.
Well, I think what I want to do is kind of get to so I'm saying that in the sense of we want to get a feel for there's a proposal of 6% increase on loss and cost in the bond servicing levies, and how that would impact the residents. So I think that's what probably most of the questions from the residents as well as the board will come. So if it's all right with you, I want to ask the board if they have questions. We'll kind of start firing away, and then we'll go into resident questions if I'm not shorting anything pertinent.
That's fine. No, that's good.
Okay. All right. So with that, I will see board if you ask.
With the 6% levy, then he said another 6%. So actually, what would that, you said a 6% levy?
A 6% loss and cost. That the county would add to the bill. We're not going to put it on our ordinance. We're not going to add the 6% on our ordinance. The county will do that.
Okay. And what was the other 6% you mentioned?
Well, the 6% is the same number. It's 6% on the police and fire pension and 6% on the debt service. Okay. We're not applying a 6%. We're doing that at zero. So there's not going to be any additional collections for the general levy.
And no increase, right?
No increase, correct.
Okay. Cool. You got a question or no? Okay.
So I think my questions, I have two of them. From what I was reading from the proposal, it appears that the additional revenue to the village would be $182,000 from this proposed increase. Am I reading that correctly?
The increase will be $182,000, but that's all going to our debt service funds, which are all escrowed. So they don't even come into the possession of the village. They go into an escrow account to be used to pay the bonds when they come due, bond principal and interest.
So my other question would be, I think my initial thought would be that instead of going to 6%, we would, in particular, given that we haven't had a lot of community conversations about it, that we would go at the 0%, which I know would decrease debt service revenue by $182,000.
Well, you can. Debt service is going to stay.
Well, not the bill itself, but the revenue that we're looking to offset it.
Well, go ahead. Finish.
So with that, then when we come into our budgeting process, which is going to start soon, we would know that there is $182,000 that potentially could have been realized here, but we may have other vehicles that we can use to offset that. So that was my initial belief or stance. So if I were to say that to you, what would your counter, or would you say that's something that is palatable?
All right. You got two items in there. I just want to make sure you and everybody else here understands. Operating levies are what we control. That is what you can control as a board. We're saying it's going to be a zero increase. It's a zero increase. The debt service levies is here for informational purposes only. You do not control them. You're going to see $182,000 increase because that is the principal and interest amortization schedule that was approved when you did the bonds. That's not in our control. So that $182,000 is going to happen. Right. So that's going to happen regardless. If you wanted to, and I'm not necessarily suggesting it, but if you wanted to lower your operating levies, take $182,000 away from your corporate levy, you can do that to make the bill come down to zero. You can do that. But that means you're reducing your operating levies. You're not actually increasing them, you're reducing them.
Okay, so
Look at this spreadsheet.
When you're saying the operating levy, we're going to be imposed an additional $182,000 on our next bond bill. Am I hearing that? You say we don't control it.
That's what I'm trying to make you understand. We're not addressing this. This is just for information. It's already set.
Okay.
There's nothing, the debt service levies are already in place. The county's going to levy them. Your operating levies, that's what we're discussing about today. That's what you're looking to pass when you pass the levy ordinance. That's what will get sent to Cook County, so they'll know what to levy for your operating levies. They already know what to levy for debt service.
Okay, so because my thinking is, if that's not set by the board, then there should be no need for a vote on it.
You're not voting on that. I only include it for information.
Okay, because when we are speaking about it, we say there's a 0% increase that the board is voting on, and then we mention 6%, which gives me the belief as a voting member that I'm voting for a 6% increase.
Okay.
That's the...
Now we're talking about loss and cost. I know this sounds a little confusing, and maybe you know, I said I include the debt service, and you'll get used to it because I do this with all my clients. I want to make sure you understand what's going on in the bill. If we just talk about operating levies and tell what we're doing, and we don't talk about debt service, we're not given the complete picture. But the operating levies is the only thing that we control. When I say we, this board can control, you're going to pass. The debt service levies are for informational purposes only. So I'm letting you know, when you say you're going to do a zero increase on your taxes for the operating levies, you're not addressing the debt service levies. Okay, you can't change them. It's going to go up $182,000. It's going to happen. Now, the question for you is, do you want to lower your operating levies by $182,000 to mitigate the $182,000 increase on debt service? That's in your control. So instead of extending the same amount of taxes as last year, which would be a zero increase, you would say, Jan, reduce the levies, which I would just reduce. The only one I can reduce is the corporate levy. I would reduce it by $182,546. Now you have a complete zero increase that will go out on your levies, but you still have to address loss and cost. That is, you come up with the percentage, the county's going to do the extensions. We don't extend them, the county will.
Question I have is, so this last 15, 20 minutes you've been talking about the operating?
Both.
The question is to vote 6% on the loss and cost. Can we focus on that?
That's fine. Then the loss and,
You're saying the operating is going to stay at zero.
I would suggest look at this spreadsheet, because it's, you know, you're reading what I wrote, but the spreadsheet, because I've highlighted, it's in red, very easy to, I think it's easy to follow. If you look at the very second from the right, the second column, it says using a 6% loss and cost. You see the dollars there in red? Yeah. $109,000 for the police pension, $64,000 approximately for fire, $301,000 for bonds. That's the additional amount of money, $474,000. That 407, that you're only voting on the percentage the county will levy it. I know it sounds a little confusing, but it is the way it works. Your ordinance tells the county how much loss and cost you want to do. You can do 0 up to 100%. I mean, you have that ability to do that. I wouldn't recommend 100. We're collecting a lot, but we are short. The villages is short that 15%. So it isn't just a question of saying, well, let's just keep everything 0, because I can tell you then if the debt service is short, you're going to be paying it out of your corporate fund, and then your corporate fund's going to be short. Somewhere it's going to get short if you don't put the loss and cost in.
So this year, were we short on our loss and cost?
This year, you had to move, I think, maybe 40,000 to make your December payment out of the general checking account, one of the general checking accounts, to make your 2009 series bond payment.
So understand, last year had a 14% loss and cost in there. You take that 14% loss and cost out, if the bonds were 4, that'd be what, another 4? You're talking close to 500,000 you'd have been short. So you would have been taking it out of the corporate, instead of 40,000, you'd have been taking closer to 500,000 out.
Okay, and so having said that, when we did our budget, my understanding was that we budgeted for the bond to be funded, and I recognize those are projected figures, so this is not an accusation that somebody did something wrong. It's just, now we're looking at what the reality is versus what we projected. Did we budget for the 40,000 loss, or did we just kind of mispredict?
Okay, debt service, when you pass your annual appropriation, you don't have to address debt service. Again, why? Because the county's already dealing with it. You don't have to appropriate the funds for it. All right? So when you were doing your debts, when you were doing the annual budget, the appropriation that you had to pass at the end of July, that's dealing with your corporate levy and your pension levies. That's all that you were dealing with in there. The debt service was already set. So the 14, when you passed the levy ordinance, you said make all funds 14%. The county knew to add the 14% to debt service, because you said all funds, even though you're not addressing it specifically in the ordinance. That's just understood and automatic. So that 14% was added in. That's why you were short 40,000. And the reason why are we short 40,000? Because we only collected 78% of our dollars. And that principal and interest payment is set in stone. You're paying 100% of that principal, and like your mortgage payment. You're paying the mortgage payment. If you only got 78% that came in, you're going into your, that you had on the side, you're looking to find, where am I going to get my other 22% so I can make that mortgage payment? And in this case, by default, and this is what I would do at any taxing bodies, is we take it from the corporate fund, we just bring those transfers over, the transfers are made. If we know we're going to be short on these debt service funds, yeah, we could start appropriating a operating transfer, a permanent transfer from the general fund to the debt service fund, but that's in the budget. And we could say, well, we know we're going to be short. Most municipalities I deal with don't deal with it unless you really have a good solid handle on what you believe you're going to collect, and then we can appropriate a number. Doesn't mean you got to do it. We can say we're going to appropriate 300,000 to transfer, and if we only needed 40, that's all we would transfer is 40, not 300. But that would give us a better picture of what am I going to have left in my in my operating levies. The revenue to help me pay bills. If I know I'm going to have to use 300,000 to pay my debt service, then that means I got that much less money to pay bills.
Operating, yes. I'm more inclined to go with that. But that's my thought. This is me speaking. Having said that, I'll let kind of the board to ask if they had any, if that wording made sense, or if they're...
My only question is if we stay at the 14%, as you just discussed, if we stay at the 14%, anything that's short, it'll be less coming out of the general fund to pay for the loss and cost, right? Because you only say, okay.
That's exactly correct. So, but that adds to the levy.
Right.
So it's where do you want to come up with that shortfall? You want it to come through the levy, or do you want to come through the corporate?
Okay. I understand now.
I understand. I don't know.
Okay. And then one more thing. We talk about the 14% that was increased. That what was increased last year is now our new tax base. Am I correct?
Correct.
Meaning If we did not vote on anything, there would be another 14%. But if whatever we vote on today does not negate what happened in the past, it's just a move forward figure that we're talking about.
And that's my logic. The 14%'s already in that base now. So that'll be in that base forever, basically.
Okay.
So that's why I was saying why I'm recommending we can lower that rate to 6, or in some cases go to 0.
Okay. Well, I think for me, that answered my questions. Any other questions here? I'm going to ask a couple of, I want to ask, Trustee, I'm going to kind of run around and see if there's anybody with questions from the residents, and then I'll ask the board for a recommendation so that, we will have to host a special meeting to have a vote for for what our corporate tax base is going to be before December 30th, hopefully well before December 30th. So there will be another announcement coming up about that date. However, I'm going to ask that residents fire their questions away. Mr. Kasparic is here to answer, and then I'll ask the board for a recommendation that we'll do to the special board meeting. Hands, any hands? Everybody's happy.
Oh, come on.
Okay,
Let it-
too unhappy. All right, cool. No, I'm teasing. Okay, so we'll go with Mr. Creighton.
Plain and simple. I want to know if we're going to have a tax increase and how much is the increase?
That's what we're discussing right now.
Well, so this meeting is for, so what Mr. Kasparic has done is made a recommendation to the board that there could be a potential tax increase, and he brought the tax bills, he brought a few tax bills. I'll make sure I'll bring one over as an illustration of what that impact can be as an example. But that decision has not been made. That's why we're here today. So based on this recommendation, once we get feedback from everybody here, the Finance Committee is going to recommend either 6% increase or 0% increase to a special meeting, and then we'll make the final determination. So it hasn't been decided yet, but the proposal right now is a 6% loss in costs increase, which is separate from operating, but plain and simple, 6% increase. All right, Trustee Muhammad's hand. Oh, he'll yield and then.
No, I just wanted to ask, what bills or whatever are we looking at that could increase, or whatever could cause us to increase from 14% or whatever? I know that you can't always predict what costs are going to rise or whatever, but if we're operating this past period from May to April or whatever, are we breaking even? Do we have a little over, or where are we at this point? Because my question is, why do we have to raise this 14%?
Before answering, the proposed increase is 6%. The 14% on there is what was done last year, so that's it. There's no mention right now of a 14% increase. So if I can, I'm going to see if I can ask this and tell me if I'm wording it correctly. You're asking why would we need to increase 6%?
Okay.
Because, and what bills are facilitating the need for that?
6% over what we had last year.
Correct.
So we're talking about 20% or 20% whatever. So the question is what you were saying, why do we have to increase this 14%?
Okay, so why is the proposal a 6% increase when we had 14% last year? That's the question.
Okay, and then that's a good question, and hopefully I'm explaining it, and if not, slow me down or just yell out and say, John, that's not making sense. Last year, the 14% was done because in prior years, your loss in cost was 8%. And it was causing a huge strain on not funding the pension funds, not to mention the debt service funds. So the corporate fund is making up those deficits by transfers, and that is shorting the corporate fund from being able to continue to operate at least in a break even. And again, it is not because of the village's ways that they're spending money, it's the tax levy. When you're putting your budget together, you're estimating your revenues. If you're anticipating those revenues to come in and then there's a shortfall, And even if we're operating at break even in the corporate, the debt service is operating in a shortfall. That means we're taking it from the corporate fund. So when we take it from the corporate fund, now we've created a shortfall in the corporate fund to pay off our debt service, which again, as I indicated, you got to pay. It isn't a question of do we want to pay it, we have to pay it. So with tax collections being in the mid to low 80 percentile, it was recommended, and I think it was a good decision. I wasn't part of it, but I'm saying it was a good decision to raise the levy to 14% for the loss and cost. That allowed proper funding of the pension funds. It allowed proper funding for the debt service funds. And we have been settling, the village has been settling their contracts with the police and the fire unions, which are the largest payroll of the village. So when you have those increases, they need to be paid, and it gets to be a very difficult balancing act to say, we're going to pay the pay increases, what are we going to cut? Now, there are things that were cut, but they may not be enough because those line items are so significant. You can't cut enough pens and pencils out of the budget to offset, to make up for the pay increases to public safety. And I think the pay increases have been reasonable. They're very reasonable within, and I know that's a little off tangent, but I want to make sure everybody understands that they're within what other municipalities are paying. And that's the way it will work, because the way the state is set up, police and fire cannot go on strike. They get binding arbitration. Binding arbitration means we're letting a third party make a decision, and those third parties always look at what is everybody else doing. So we're not going to get under inflation rates. And if other municipalities are settling at 2.5%, 3%, that's what the arbitrator is going to do, whether we want to say yes or no. Again, that's in a state law, so we really can't even control the public safety and pay increases, because that's set by the statutes have tied them up to say if you can't get to a mutual agreement, arbitrators will figure it out. So when I was looking at the numbers today and talking to Chris and where we're at financially, I didn't see the need that we need to do another 14% on 14%. Keep in mind, last year's levy went up 14. We're extending last year's levy, so that had the 14% built in. That is why I'm able to say, let's reduce it. We don't need to do 14%, because that 14% will hit your bill. If you go and look at your bills, your second installments, look at your village of Dolton. It was about a 14% increase from the prior year. That's what loss and cost does. It's going to add it to the bill. So I'm not suggesting to do another 14%. In fact, at 6%, when I bring that number up, keep in mind, I'm not saying 6% to the operating levy. So I'm not talking about the corporate levy. I'm only talking about police, fire, and debt service. So that 6% is really effectively coming down to a 3.09%. Because part of the levy is there's $7 million we're not applying the 6% to. So it's only being applied to, looks like about another $7.5 million. So about half the levy is getting the 6% increase. The other half is not. So again, that's up to the board. I just want to make sure the board understands all of the different ramifications. So if we don't do debt service, it's not going to end the world. It's just going to be that when that's, as Chris mentioned, we were $40,000 short. If we were $40,000 short last year, and we're going to be over $300,000 short this year, because we won't have that the loss and cost to make up for that deficit. So that $300,000 would not be in the levy. And that means if you're already short now and we're going to be $300,000 less, it's simple math there. We will be short in the debt service funds. So does that kind of answer, or is that too little, too much?
Okay, how you doing, John and Chris? I want to preface this by saying that the Kasperick Group of Certified Public Accountants is a very good organization. And when I was a trustee, we voted to put them in and to reassess their contract in April. My question is to the board, not to Mr. Kasperick. As you all know, the Kasperick bill is approximately, what, $23,000 a month, correct? Is that about right?
Yes.
$23,000. And they've been in service now about a year or more. Is that right? About a year? So we're over 200 and something $1,000 in their billing. We were told that there was going to be a finance director that was going to be hired. The mayor mentioned Ms. Redmond coming back. Apparently that didn't happen. So this is to the board. And John and Chris can jump in on this. Does our surplus in this budget still remain? We had a surplus of $750,000 on paper. Does that still remain?
As of October, I believe you guys still have a surplus.
Okay. And the cash on hand, I know, John, you said you couldn't answer it the other day. Did we find out what cash on hand was now?
As of October, you guys did have a cash on hand, which that was because you guys got your real estate taxes in October.
I know, but once the taxes were, that's October, this is December. So in November, when we received those taxes, which was the remaining of it was 50-something percent, the second installment was 40-something, which came out to 78-point-something percent. After that, meeting our bills, what's cash on hand now, do we know?
I can't tell you for certain, I haven't gotten through all of them.
Okay. Will we need to secure a bond for the next budget?
I'll just ask that we're not in that budget prep period, so I think that question may be a little bit early.
Let me tell you why I asked, because this information that we got here is from John's letter to the board and to the mayor. Is that correct? That you handed out? So I'm basing it upon this. My last question is this, because I don't want to monopolize this mic. And this, again, this is to the attention of the board, because this kind of reminds me of being in class, because most of the eyes are glazed over when you talk these terms, EAV. Most people are not understanding what's going on. Somebody asked yesterday about the Melanie Fitness and saying, you know, what kind of monies are brought in, because all that is related to the budget, all that is related to the levy. This is my question. On your first page of your letter, the last paragraph, next to last, it says, the tax rate of the village rose from 6.789% to 7.956%. It is the tax rate that is multiplied against the EAV of your property and determines the amount of the real estate taxes for your bill, which you've been explaining. Keep in mind that we are only one of several taxing bodies that are included in your tax bill, and you named them. You said you also have Cook County Forest Preserve, Metropolitan Water, Thornton Township, South Suburban College, high schools, District 2, so on and so on. My question is this. Recently, we took $50,000+ retroactively going back to 2009. We unilaterally did that as a village. So if all these taxing bodies get a piece of that TIF that we did this accounting thing that was just voted on recently, unilaterally we did that. Can these different taxing bodies come back to the village and say, hey, what's up with that? How can you say that we're charging that TIF $50,000 going back, what was it, 2009 up until present? How can we do that when all of these taxing bodies weren't able to benefit from that? And that's in your letter.
You're talking about the Indulux transfer?
That wasn't in there, but I can address it.
Okay.
Well, I think I can address it.
I can, or you can't. The Indulux, I'm coming right back over to you, Trustee. The Indulux fund were bills that we already paid over the course of that year. When we paid those funds, we did not deduct for the services that the village provided on behalf of that, meaning we provided insurance for the TIF, we provided record keeping. We did not deduct any of that. So by the law and at the advice of Kasperick CPA firm and at the advice of our lawyer, they advise we can go back and recoup money because in essence we overpaid the Indulux fund. So since we're entitled to recoup funds, we wanted to recoup it. Did I word that well?
Correct.
The amounts how we came up with the amounts was by statute or by law. So what the maximum that the law allowed, or that's what Attorney Kinkard came up with, that's where he came up with those totals. Yes.
Now the rest would be different taxing lines if they were to protest that.
I can address that. The TIF laws in Illinois do allow for a municipality, because they are handling all of the administrative function of the TIF, to charge an administrative fee which would come from the incremental taxes that are accumulated, that are put into the special fund of a TIF. The village was not assessing an administrative fee, and that's not uncommon for a lot of TIFs when they're first created, because you're not always sure about how much increment you're going to get in. The idea of the TIF is to help stimulate the economy, bringing in new business in areas where we don't have, or getting rid of dilapidated buildings and paving the way for possible new construction. So it is not uncommon that they will not assess a fee, because it isn't trying to get rich for the village, it's to try to get the property going. At given points when these TIFs get much more mature, then you can look back, if you are developing surplus funds, before you declare a surplus and then let that go back to the taxing bodies, you have this administrative fee that you can charge. And you can go back and charge it from day one for all of the work that was put into the TIF, the monitoring of the TIF, paying the bills related to the TIF, which is typically just being borne by the general operating fund. So there is nothing that, to answer your question, that other school districts or other taxing bodies can come back and say, no, you can't do that. Yes, the law will allow it. And now the question you ask is, what is a fair administrative fee? The law doesn't, to my knowledge, it doesn't get into specifics like saying 4%, 8%, 1%. It really is depending on how difficult it is to keep track of a TIF and all of the work that's taking place. And so it's an arbitrary number. Now, the balance of that I would leave to an attorney to ask, because I am not aware of lawsuits from school districts regarding saying that the admin fee was unreasonable. I have seen, though, where that school districts may sue if the money is not spent for the intended purpose. But to go back and say we're going to charge for an admin fee, I'm not aware of any, but I would acquiesce to that to Vince Kankar, who is your TIF attorney. He's the one that, when we discussed it, I acquiesced to him. I said, you're the lawyer, you're the one that would best understand. If you feel those numbers are reasonable, then fine. I mean, there is a lot of accounting that goes on with that. And so I guess I'll just leave it at that.
So I'm going to respond. The question was about our finance director. I am going to respond to that. Please remind me if I don't. I want to keep with the tax portion, and then after Mr. Kasparic is done, I'll talk about the finance director. But hold me to it, and I know you will.
Hi. I just have a few questions. And if I recall, Melody Fitness Center, and it have been stated in your summary reports, that was losing, I'm just going to throw this figure out, $300,000 per year. Am I correct?
I know it's losing money. I don't know.
The proposed budget had a budget deficit of approximately $320,000. That was budgeted prior to some of the enhancements. So I think the question that you may be asking is, where are we at? I don't believe we're going to lose the entire $320,000 that was budgeted. Okay, let me ask you, please.
And this is pertaining to the 6% increase that you're suggesting that we do on the taxpayers, and we just did 14%. Now, my thing is, with Melody Fitness Center, it was suggested that you get rid of it, okay? Because instead of taxing me some more, and you have this piece of property, and you are not making any money off of it, then that's a debt. So why put that burden on the taxpayers, that 6%, when we just paid 14% last year?
Well, to answer the question, when I did present that to the board at a meeting, the facts are the facts. Melanie Fitness Center has lost money every year, but whether you run it is it supposed to run at a profit or not? That is really up to the board, not up to me as your financial advisor. I'm only going to tell you if it's making money or losing money. If you feel this is a great benefit for the village of Dolton, that it is something we don't want to, that the board feels we need to continue and do, then as I talked to the trustees at that meeting, I said, then we just have to look at ways where we can try to streamline some of the costs as best as we can. Maybe really do hands-on, go back down and look at every single line item, see what's going on, see if we can cut expenses. But again, it's a board decision. So as a finance director or as a financial consultant, I would only say, hey, it's losing money. But if the elected officials and the public say we want it, then you want it, and then you just have to figure out other ways. I'm not going to say that because of the loss to the Melanie Fitness Center, there's a direct correlation to the tax levy. The tax levy does not pay for 100% of the bills to begin with. It's a percentage. I don't have that number off the cuff, but it's we also get state income tax, state sales tax. There's a lot of other revenues that come in. When I talk about the loss and cost, keep the framework in the sense of what are we collecting. That's where I'm at with that. I'm not, the debt service, yes, I do bring that out because there is no other source of revenue that comes in to pay debt service. We don't have sales taxes. We don't have income taxes that are deposited into there. The only thing that goes in there is real estate taxes. And so when it's short, we take it from the general fund. And that just puts a further burden on it. So that's the reason I talk about loss and cost. I think it's also important to know that the 14% loss in cost, that was a one-shot based on the levy that was last year. Okay?
Correct.
We start with the debt service is clean every year. It does not have that 14% compounded in because it's going to be the principal and interest that we are going to pay this year. So we know we're going to pay $5 million this year. If we're going to collect 80% of the levy, that's why I'm talking 6%. Unlike the police, fire, the operating levies, yes, that 14% is now built in from prior years. It is not built into the debt service fund.
Yes, I understand that.
Okay.
Also, I want to talk about, you can make $1 million a month. If you don't budget it properly, you're still not going to have anything. And that's why I wanted to know, is the budget to actual as of today's date? Chris, is it possible you can answer that?
I haven't looked at financials. It's too early for me to finally have all the financials for this month, for November.
And also, I wanted to talk about recent hires. To my understanding, you just hired police officers to view the cameras, and I know you don't have anything to do with that. Okay? I said, but were they included in this year's budget? Did you budget for that? And if so, how many did you hire? And can you tell me, because these were retirees, how much did they get paid? Because I'm looking at all the money, because my taxes are over $14,000 a year. That's quite a bit of money for a retiree. And even though I own a building, I can't keep going up on my tenants, otherwise they're going to walk.
Okay, so I want to see, were there any other hands? Otherwise I'm going to have a seat. All right, Mr. Creighton. I'm not, you're not finished? Uh-oh, you'll keep me on a high. Okay, so police officers, when we budgeted, I'm guesstimating about 35 patrolmen, and at the start of the year, we were short 5 patrolmen. So we did, later in the year, when we had a spike in crime, the board then approved to hire additional officers. So there 5 were budgeted. The additional officers were approved by the board based on the need, but we did not re-budget based on the new hires. If we get to an amount where we are grossly over budget, we will look at re-budgeting. But given that we have a operating budget of approximately $23 million, every time we make a change, we won't recommend rebudgeting for every one of the changes. If we see things are grossly out and we generally would go off of a percentage of budget over, then we will make those adjustments because we want to be responsible. But then we would also, if every time we made adjustments we rebudgeted, we would be spending a lot of time rebudgeting and not time on analysis and on other things. If that answers the question. Yes.
Okay, and a lot of residents in the community are senior citizens. So they get a senior freeze, correct? So in the event, can you explain to me how does this work for the seniors that are watching? In the event the board decide to vote for the 6% increase, and they have already received their senior freeze for this year, and they have to apply every year. So would it go up 6% and stay at a freeze once they apply for that senior freeze again?
I think that would be a better question to ask of the assessor's office, because what I do see, and I don't understand all of the complexities of how they compute that senior freeze, but from what I have seen now as a tax preparer, when I'm preparing tax returns of seniors, more often than not, I don't see any increases in their tax bills. The seniors, especially if they have less than $55,000, their tax bills don't see that. I've seen a number of tax bills go down, to be perfectly honest. And I don't understand the mathematics of how they compute it, because it's that senior freeze portion that I don't get. I understand the exemption of a homeowner, I understand the senior exemption, but that freeze has a more complicated computation. So if you're someone making less than $55,000, I would imagine this increase it probably won't even hit your bill. But again, we're one part of the total bill, so I can't speak to the rest. That question, maybe Cassandra Holbert from the Thornton Township could possibly answer that question, as far as an assessor is concerned, on how that senior freeze is computed. But for anybody here that's a senior, that has that senior freeze, and you see your taxes being frozen, this increase here, if it even hits, it would be so small, it would be very negligible, because your portion of your bill will be small.
Okay, and when you say small, and I really didn't understand about how small, when they talk about buying your medication and buying your food and paying your taxes, until I took care of my grandmother. And what she received was next to nothing. And that small $35 that you're talking about, it really do hurt some of the seniors. And I want to ask the trustees, either one of you guys know how that work? In the event the 6% is voted on, how does that exactly affect the seniors that get the freeze? Because they have to apply for this senior freeze every year now. It used to be a time when they didn't have to do so. Maybe you might know. You don't know? I'm surprised. You got
The freeze you do apply for every year, but the homeowners and the exemption stays. So the increase, I'm sure it won't be $35 on a senior, but that all depends on, like he said, if you make under $55,000, then it should be a little of nothing. I do my grandfather's every year, $50,000. He has a 3-unit building, pays $127 in taxes. And I make sure that is done every year, because if you don't, then the taxes will go up, but I can appeal it, and then they'll pay that money back. But he doesn't pay no more than $127. No, he lives in the city. But even out here, the same thing. If you're under $55,000, doesn't matter where you live. If you're under $50,000 a year, the taxes will not go over that. I mean, it won't be much of an increase, even if it's 6%. Because you're looking at a senior's money. $55,000 is no money. If you actually look at it, there's no money, $55,000. $55,000 is nothing. But if that's all what they're making and lower, but I'm just saying, if it's $55,000 is what it has to be in order for those taxes to be low. Anything under $55,000, you won't see a huge property tax. Even if it's an increase, you won't see a huge increase. Now, if it's something over, I can't speak on that because I know his is under 55,000, and I can only speak on that for anyone that's under 55,000. But if Cassandra Hobart is the person, maybe we can get out here for a housing meeting and have her to come out and explain those property taxes. That'll be a good thing for us to move forward for next year.
Next year.
Well, the housing meeting will be next year. I won't have a meeting. We're in December now. So we definitely will get her in to explain that increase.
Actually, we need to know that now.
Well, you're on the time frame. This thing has to be voted on. That's the reason why he's having an emergency meeting now. This has to be voted on. I mean, and even if I ask, could she get out? Don't know a person's schedule, but I'll try and see.
I'd like to know how you're going to arrive at the amount or the percentage, 1 to 6. I keep hearing 6%, 6%. This is saying to us 1 to 6. So now, are the trustees going to come up with something 1 to 6, or are we at 6?
The proposal, and I know it's sometimes confusing, especially if it's the first time you're getting it explained in this type of depth. Again, the levy that would be voted on, showing a zero increase in the debt service, a zero increase in operating levies, is a zero increase. Debt service is going up. Debt service on top of the zero increase will make it go up 1.2%. That, if the levy is voted on just the way it was presented, that's what would happen. But I also brought up, because it has to be addressed, is the loss and cost, because there's a paragraph in our ordinance that says to the county how much loss and cost should be added. All right? Currently in existence, if they do nothing, it stays at 14%. That's why I brought it up to the board. I didn't think 14% was necessary. And when I use the term 6%, let's just back it down. 6% on some of the levy, not all of the levy. So the effective rate I'm talking about, or the rate, is a 3.09 if we add that 6. Because again, we're not adding it to the whole levy, we're only putting it into a portion of it. But that's up to the board. When we draft the ordinance, the ordinance will say that a 6% loss in cost will be added on to the police and fire pension funds and the debt service funds. That's it. So the county will know not to add the 6% to the corporate levy, which is $7.4 million. That's just going to stay as requested. It'll be a zero increase. So you have all these different parts. So 6% is being out there because we're saying we're going to use that on the pension funds and debt service. But because there's no increase on $7.4 million for the corporate, then it's not a 6% all the way down the bottom. It's 6% on those, and when you add the total levy together, it's only 3.09. Now, I say only 3.09. I'm not making light of that. I'm just saying it's not 6, it's 3.09. So and that's up to, again, and I just want to make sure the council understands the consequences if they say, John, do zero. Well, you're doing zero, and we already know we're not even going to come close to collecting 100% of the levy. You're going to take money out of the debts. You're going to take money to pay debt service. It's just a question of how much comes in versus what is owed at the time. And so, as a finance director, I don't think that's a prudent way to deal with the deficit of the debt service, to take the money away from the corporate, because corporate's already strained. I can guarantee all municipalities, school districts, everybody has those problems because those corporate levies are your main operating levy. And as was already brought up, you hired a few more police officers, and I know obviously the public likes to see the police officers out there. You've got your public safety, your fire department, and the ambulance services that you have. You know, where do you start to cut? There's never an easy solution. I mean, you try. I know I deal with this all the time, so geez, this is what I do all the time. But I leave it, it's an idea, it's a starting point. Is this where you want to go? This is what I would recommend, but it doesn't have to be that way. I mean, the village could say more, which I don't think the public would like, or the village can say less, and if you say less, then okay, then we just have to figure out how it's going to work. But it could, you know, if it becomes a major problem, it may force us to raise taxes in the following year higher than we wanted to because of the fact that we created the shortfalls this year. So that's just, It's just really up to the city, up to the village board. And I said, I've given you options. This is unlimited. I can make this puzzle any way you want it to be. I'm just coming up with one that I think is the way I would recommend it. 0 increase for operating, put some extra money in for the police fire pensions and the debt service, and call it a day at that. But you don't have to do the way I presented it, except for debt service.
Since collections is tied to loss and cost, and you're recommending the 6%, does
Correct.
that mean that you're anticipating the collections to be in the 90s?
No. I
What-
understand that the collections are going to be in the 80s. We're going to lose that money.
Okay.
But I don't want, but I think that's a real good question. No, I understand we're not going to collect all that money. The levies set for the police and fire, we have a range. We got the recommended and the state statutory minimum. We're going to exceed the statutory minimum, but we're not going to get to the recommended. That's fine, we're okay. Debt service, trying to keep at a minimal on the amortization schedules. I can tell you that the amortization schedules were raised 10% when the bonds were issued above principal, so they're already making up that 10% of that loss. So if I take 10% in 6, I'm at 16%. Again, though, if we're at a 20% shortfall, we're still going to be short on the bonds.
So then that puts an additional burden on the general fund?
Absolutely. General fund will always make up any deficits of these funds.
Okay, so if that puts an additional burden, I guess I'm coming to the trustees now. If that puts an additional burden on the general fund, what does that mean for the citizens?
Okay, so from my understanding, when we do our budget, correct me again, we do not budget for 100% collections because we know that's not going to happen.
Correct.
So we will not again budget for 100%. So I don't look at this 6% as the 100 minus 6%. I think that it's in recognition that next year we do know that the debt service will increase by approximately 6%. And is that money going to come from this 6% proposal, or will that money be set aside from the general fund? Yes. Did I answer your question, Mr. Creighton? Okay.
Will you also keep in mind that other governing bodies, such as the school board, might do an increase too, and that's one of the highest taxing bodies out here is the school board. You have the library board, with Park District. Would you please keep that in mind too? Thank you.
I'm going to sign Trustee Steve to make sure that the other bodies do not increase. No, I'm teasing. We will keep that in mind.
Trustee House, if I can just make a
Yes,
point
sir.
of information for the public. I did mention it at the Monday meeting, and because I have so much information, some of it might get, as the trustees stated, glossed over. There is, in effect, in Illinois, the property tax extension limitation law. That limits a levy increase to the CPI of the prior year. So in this case, December 31st, 2018. The CPI last year was 1.9%. So when you're looking at all the other taxing bodies, exclusive of us, and why do I say exclusive of us? Because we are a home rule unit. We are, Cal City is, Burnham, to name a few. When you are a home rule unit, you are not under the PTAL property tax extension limitation law. That's why there is a lot of discussion on this, because what this board says is the final decision. When I work with those taxing bodies that have the PTAL limitation, we know we're only going to get 1.9, but it is a little bit of a convoluted computation, because you got to take into consideration new construction, which can change that number a little bit. So when those taxing bodies are requesting 4%, we know they're not going to get 4%. When they have 4%, 6%, 10% on the loss and cost, that doesn't get automatically added because the extended levy is going to be 1.9. So to answer your question, they'll go up, absolutely. The schools are going to ask for that 1.9, so you can be certain they'll go up 1.9. Most of the south suburbs that I deal with, they're pretty much landlocked communities, so we don't have a lot of new construction. So we're pretty much going to get those entities that are non-home rule. 1.9 is what they're going to get, pretty close. But in our case, that's how we, being non-home rule, that's why more discussion is taken. I wouldn't even waste time on the loss and cost if I knew it was going to be 1.9. I'd say, who cares? It's going to end up at 1.9. So, but in this case here, as a home rule community, we do dictate what it'll be. That's why I try to give that whole picture. I know it's confusing, but I'm really letting the whole public know, as well as the board, this is what's going to happen with the levy. If we wanted to just say truth in taxation, and we're following the law to the T, this is zero increase and we're done for the day, and that's all that needs to be discussed. The rest just happens automatically because there's no laws that require any disclosures on those. But I think this is giving everybody a good opportunity to understand what makes up that tax bill. And believe me, I understand, because I too live in the south suburbs. I see these high tax bills, and what I pay in my offices in Calumet City. I live in Calumet City. I dump a lot of money, and I'm not a senior, so I don't get those senior freezes. Though I'm working there, I'm getting in about 3 more years. But at least I get the senior exemption. But so I'm very familiar with that, and I try real hard, and that's why the board, I've got into in-depth analysis with the board, creating this booklet for them. It's just not walking up, and there's the history of the village. I mean, there's so many things that are causing our problems that are not borne by this board. I mean, everybody here was old, remembered the housing market crash of 2008. That has destroyed our EAVs. Our EAVs were substantially higher in the past, way higher, and our tax rates were way lower. So therefore, we all remember our taxes being lower. Well, as the EAVs dropped, taxes didn't drop, so it made all those tax rates go up. And so depending on the mix of a community, I can tell you with Calumet City, you have a lot of heavy industry here. Calumet City has a lot of commercial property. They have the River Oak Shopping Center. And in a span of less than 8 years, it's dropped over almost $80 million. It's half of what it was once valued at. And so who picks up the difference? All the remaining all the remaining people that have property in Calumet City are making up for what that mall was one time paying. So even if our property values are going down, taxes are going up. And that's kind of the same thing here with the industrials protesting taxes. They're no longer paying that full freight like they once were. That those dollars are now rolling on to all the other property owners.
So I have a question. Property tax is definitely out of my wheelhouse, but I learned a lot and I have research to do. I do know that. But I just wanted a bit of clarity on what Ms. Parker asked. So the 14% from last year, should the board vote to increase the 6%, that's 20%, right? Following? That is 20%, right? Is that a permanent increase that we'll have from this day forward? Or is this just a temporary thing to fill a gap?
That will typically be, unless the elected boards decide to roll back the taxes, it is built in as a permanent increase. So I already indicated that. I mean,
I would just want it to be clear. I wanted to be clear. I heard it, but it didn't register, and I wanted to make sure I understand that last year 14%, this year 6%, that's 20% increase, right? On loss and cost. So let's say in a miracle situation that we get our budget together, would there be a vote to lower that loss and cost?
Well, that's already today we're already talking about lowering the loss and cost. We can always
by increasing the...
Well, the ordinance that was drafted, and this is the way they're all drafted, it says 14% increase from now until changed. Meaning, if we don't change it, 14% is automatically added on.
Okay.
Okay, so if we just didn't address it, 14% was going to be added on.
Right.
All right, and that's what I was bringing up, because again, we're a home rule community. I understand how that's going to impact. So I wanted the board, and I was explaining to a couple of trustees, we don't need to do that 14 again. That's just going to drive those rates higher. When you drive the rates higher, those people that are barely holding on paying taxes are just giving up. And that just means we're going to have less taxes coming in, so we're defeating the purpose of raising up the loss and cost.
Exactly.
So that's the reason, and the only reason I was recommending on the pensions and on the, again, it's a recommendation on the pensions and on the debt service. I mean, debt service, I know what's going to happen. The pensions, we may not have to make up the difference because I have a range to deal with. I don't have a range to deal with debt service. When I say I mean the board when I'm putting these numbers together. So if we don't do the loss and cost, it's a slam dunk. We're paying it out of the corporate fund. If we don't do the loss and cost on the police pensions and the fire pension, they may not be, it all depends what comes in and where do we fall within the range, how close are we to the required contribution by the state. The pension boards give us 2 all the time. That's the way they all work. This is what we'd like to get. This is what the state says you have to do. All right, we have to make sure we do the have to do's. So we're above that. This is going to definitely keep us above, but I got to back out then the fact that we're only going to collect maybe 80% of that. Is that 80% still keeps us in the range. So we're going to be okay so that the pension boards don't have to come back to us. That's why I was including it on there. If we didn't include it on there, that's up to the board. But I would still say as their financial consultant, please keep the debt service because it's not going to do you any good to let it go. If you don't want to do the extensions on the pensions, that would lower it a little bit more. That would probably cut that down to about the 1.2 or 2, I should say, %.
So here's another part to the question. So the taxes that are received from people that pay property taxes is coming in at 78%. That other, or 79%. That other 21%, is that due to vacant properties or people not paying their taxes? Which one is it?
Combination of all of them.
Combination.
I mean, there are property right now where people are living and they just don't pay the taxes. The municipalities don't have any authority to go in and
that's a county issue.
It's a total county issue. The county assessor and the state law, which you'd have to, and by the way, I do talk to our legislators about this. The state law doesn't work anymore. Before the housing crash, if you didn't pay your taxes, the mortgage company did, because the mortgage company, that's what was securing the property. They didn't want to lose it. And not to mention the fact that, a $300,000 home, if I put down $5,000, I can end up owning that home if I pay the taxes. So taxes were in the high 90s. But because of what happened in the housing market, it's really just changed the game immensely. The fair market value of the houses have dropped below what the cost of the mortgages are. Who wants to pay more than what the value of the home is? Take the home. I don't care. I'll go buy another home somewhere else. Because if I walk away, probably I am insolvent, so the bank can't sue me to get the money on the mortgage anyway. And that is the philosophy that is out there. That is it. So because of that, and it's driving those prices of the homes down, when you look at the taxes, that's what's driving them up. Now you got, so there's businesses that have walked away. People have walked away from their homes, so you're right, vacant homes, taxes are still being assessed on them. If businesses has decided to walk away because they just can't afford the taxes, they don't care, they're not selling the building, they're like, here, have it. But the problem is the county levies on them. And then if there's nobody protesting those taxes, they'll continue to go higher and higher on that parcel of property, yet they'll never get paid. And what ends up happening then is that the property taxes in arrears get so high, the only people that can take that is a municipality, a la a village or a city. They could go through and claim the property and get all the back taxes wiped out. So it's a combination. It's nothing we can do to control it. Since it's that number.
I'd like to touch on something that Ms. Stubbs talked about with the Melanie Fitness Center. And I'm talking about it because it's a large number. If it is 300,000 a year, which over a 10-year period is $3 million. A couple of years ago, Attorney Murphy gave us trustees a comparison or a document letting us know what the Dorchester, which is now sold, and what Melanie Fitness had cost this village over a 15-year period. And the Melanie Fitness Center over that 15-year period, we had lost $4.7 million. Some of the board members wanted to sell it and cut the loss, and others thought that the number we were trying to sell it at was too low. And at that time, I made a comment that if you lose $300,000 a year and it takes you 3 years to sell it, you're going to lose $900,000. So let's take the $350,000 now instead of trying to get $800,000. That was a couple years ago, so we've lost another $300,000 to $600,000. What is this board's intention with the Melanie Fitness Center? Do we intend to just continue to lose money? And it's this board's decision. I'm not advocating for anything except my taxes went up last year, in 1 year, $1,400. I don't know why they went up $1,400, but they went up $1,400 in 1 year, and I really don't care to see increases every year when we, to me, waste money. Unless they're going to tell me I could go work out for free, then I'll go up there and go to Melanie Fitness Center. But all jokes aside, $300,000 is a large number. And I see things going on where you're trying to cut that, but everybody don't want to pay for that. And so I'd like to know what your intentions are, to sell it, to keep it, to lose money.
I'm going to try. Well, I'll let Trustee Steve first, and then I'll. Oh, here you go. Okay, so I'm bringing this up as it connects to the taxes. So the intention, or what's happening right now, is there is activity to minimize, and as we talk about with the budget, all things, even with this, all things are options in terms of ways to balance the budget. So when we go into the budget again next year, there will be recommendations. Some may say maybe we sell the Melanie Fitness. Some may say we keep it, and we want to look at where it is. So at this moment, there has not been any discussion in terms of selling it. Trustee Steve has kind of headed the Melanie Fitness Center in terms of revitalizing, minimizing costs, increasing revenues. There have been some increases, but we are still losing money. So I won't try to hide that fact. And at our next Finance Committee meeting, I think we'll make that an agenda point to talk about what those numbers are, the trends, and where we're at. But having said that, I do not discount any option that is presented. I think we need to have more conversations, agree or disagree with a 6% increase, sell the Melanie Fitness. All options need to be brought out, discussed, and then we need to move forward. So the Melanie Fitness Center, at this moment, there haven't been no discussions of selling it. As we move into the budget period, which will be coming up between January and February, I'm sure that will be a topic of discussion. But Trustee Steve.
Yes, of course, I'm the trustee over the Melanie Fitness Committee. And you're right, since I've been in office, I haven't talked about selling it. The goal is to make it self-sufficient. At least make an honest attempt at making it self-sufficient. Being that you may be one that wants to get rid of it, there's a lot of residents that don't want to get rid of it, who depend on it for their health and for their life. And health, everybody know health is wealth. So for the residents and the people who go over there seriously, I want to put an honest attempt in it to try to make it self-sufficient. And we're up. We're up since the pool's been open. So we got some new things coming over, so the revenue is coming up. Yes, it's still losing money, but it's not losing money like it was over the last, we made more in the last 2 months than we made in the last maybe 16 months. So it's in the process of improving, and that's what we're going to do. And like Trustee House said, at budget times we can talk about if we're going to keep it or we're going to sell it. You know what I mean? But right now, we are working to improve it.
But when did you say we'd have those numbers?
I will we'll have it definitely by our next Finance Committee meeting. If there's some, if there's a substantial meeting to kind of discuss it, then we can hold a meeting ahead of time. I do want to point out, and I'm coming to your question, the things that we're talking about now, whether it's the 6% increase, Melanie Fitness Center, all of these are things that we have to look at whole as the big picture. So every time that if we decline to do something, so if we decline the 6%, that does put an additional burden on the general fund and other services we can that we can do. That doesn't mean we have to do it. It just means we want to make sure that we're realistic about what things we can do, what things are priorities, and what we don't. Similarly, as Trustee Steve was mentioning, if let's say that the Melanie Fitness Center, we budgeted for $300,000, we lose $200 this year. That's $200,000 we could have used for other services. However, there are people that depend on it, that need it, and it may be something that, as a community, we want to maintain. That's the reason that we need to make sure that we are consistently having the discussions and the conversations, because while the board votes on it, we represent every resident in here. So our vote, we should have an idea, but our vote needs to represent all of the people that we talk to. So I don't think that there's anything that's off the table. We need to talk, and I hope that we start to kind of deprogram our minds, because sometimes we see things on an agenda or we see things come out and we assume, oh, they're trying to raise my taxes. Well, no, we need to talk about it. And we need to talk about the Melanie Fitness Center. We need to talk about any of those things. But be mindful that every time that we refuse to increase or we refuse to cut, then that puts another burden on different parts of the administration.
Thank you for that, Trustee House. John, since you're holding class, just two questions. Number one, you keep mentioning the term debt service for the residents. Define to them what that means, and what are we paying debt service on? Number one, and then I have a second one.
Okay. Debt service is when the village issues general obligation bonds that will be backed by the full faith and credit of the village through real estate taxes. So we're giving the county as well as the investor the security. Well, actually, it's not the county. We're giving the investor the security to know that the real estate taxes are the backing to repay the bonds. Okay, so for 2019, and we have a 2009A GO bond, a 2009B GO bond, and a 2009C GO bond. That means it was a series of 3 bonds issued all at the same time. The levy that will be extended for the 2009A bonds is $1,395,460. The levy for the 2009B bonds will be $608,031, and the levy for the 2009C bonds will be $1,417,350. And then we have, and the village has been doing this for a number of years, you have a GO bond with Homewood Disposal. The bond is issued, and then the proceeds from the bond are used to pay the Homewood Disposal bill. That levy to be extended this year will be $1,600,000. So when added together, the county is going to levy $5,020,841. So that's where my $182,000 comes from. This is not anything to do with loss and cost. So I know that sometimes it's confusing, I get it, but debt service does not roll with loss and cost. We create it each year new, because the dollar amount we're doing is brand new. It is not an extension of the prior year. There is a computation of our outstanding obligations. Last year, we had 2 bonds that are now paid off. In 18, we completed paying off the 2004C and the 2004D bonds. So those bonds are not being extended. So, because they're paid off now. But we still have the 2009. They're going to be around for a few years, still more than a few years. This Homewood Disposal is a 1-year bond. So
okay, but the balance, I mean not the balance, but the total of principal and interest that we're paying back on the bonds is approximately $5 million a year.
Correct.
Is that what you said? Okay.
Correct.
I want to give this board credit. So it's not a speech, because they were going to vote yes on this without knowing any of this. And I'm glad that one of the trustees decided to table this to have this discussion. And this kind of reminds me of my calculus class in high school when 80% of the students were glassy-eyed. They didn't understand it, but they didn't want to feign the ignorance of asking the question, because this is your bailiwick. I mean, this is yours. Chris's, I don't discount you because you're here, because this is the man that does most of the work here that I know a person. Not to say that you don't do the work, John, but this man is here every day. Is that true?
That's true. He runs day to day.
Day to day, yes.
Me, I get into this stuff.
Yes, without a doubt. He's a quiet person, but he knows his stuff, and he will tell you the truth regardless to whom or what. But I would behoove all of the trustees, instead of just doing a yes vote and bobble your head saying yes, if you don't know it, table it and have a discussion like this, because if you didn't know, I'm sure you'll admit, those who didn't know, that they know now. And for the future, for any vote that you're going to make a sincere vote, have some knowledge, some background on what you say before you say yay or nay on it, because this is very important. These are our tax dollars. This is a serious meeting. And when someone says that $35 can make or break a person, that is absolutely true. Mr. Trump, our wonderful president, is going to cut off 750,000 people from the SNAP program. Now, of course, we hear that like, yeah, well, that's what they get. They probably can get a job. Some of those people need to have food stamps. Some of those people need to have food stamps. A lot of those people are in Dolton. And the elephant in the room, I'm going to say it, a lot of our residents are those seniors. We're losing money on the exemption. Politicians won't say that because they're getting a discount. Those of us paying a retail amount are the ones who's really funding the village. Those seniors who pay $400, I know a senior is paying $300 a year on his taxes. He showed me his bill, $330-something a year. When he showed it to me, I said, what happened? He said, this is the senior exemption and the freeze that I get. So imagine we are a majority population of seniors who are over 65 who get the freeze and exemption. And that's, I'm not dogging them out because they deserve it, because you're in your twilight years, you're 65, you have more years behind you than you have in front of you. But we have to understand that the revenue that we're receiving, and the majority of that revenue is from taxes, real estate taxes. I think that's in your letter, right? The majority of it is, and we're almost a bedroom community. There's not a lot of industry here. It's not a lot of business here. I think most of the money that we get is from the real estate taxes, and as you mentioned, income tax and sales tax, and not very much on sales tax. But I would implore the trustees, and I'm glad that they're here to learn. At least they were here. I was looking for one of the other trustees because all of them should be here to get the lesson from Mr. Kasparic. Well, I hope they're all here. And to learn, because if we're going to continue to say yay and not know what we're voting on, we don't have a finance director. And again, John, this is no disrespect to you. Your bill is big and you warned the village. I'm not cheap and I'm not real expensive, but $23,000 a month, you do the math, okay? But we need a finance director.
Thank you for your comments. I will say that, at least for myself, I try my best to be averse of everything or communicate, and I believe that members, see Trustee Denton here, on her day off again. This is not even your commit. No, Trustee Denton, Trustee Henier was here, Trustee Holmes, and then of course the trustees here. And everybody came in on a emergency notice, on 2 or 3 days notice. So I was going to give my thank yous later, but I'll thank everybody. Mr. Kasparic, Chris, again, for making themselves available for this conversation. But all points are noted. I want to say Trustee Steve.
I want to say one thing, that the last board meeting, I know one trustee wanted to table this before we got a chance to discuss it. And I respect the fact that Jason House said, well, I will vote on it, but let's at least have the discussion first. And after we had the discussion, then we went back and forth with him. That's when we tabled and decided to come to committee. So that I had some questions that I had to ask there, and I had some more questions I asked him offline. So I'm very clear about it now.
Okay. No more hands? No more hands? Yes. Was that a wave? I think you were sneezing. No, I'm gonna. I have to answer your question about the finance committee.
I got to answer about not being a resident and not making a statement.
We're gonna. Yeah.
Okay. So no, these are. So I got a couple of quick questions. The first question is, the police, the fire, and the debt service, are those paid directly from the county treasurer to those organizations, or does that money come to the village before it's paid?
The money that goes to the pension funds?
The pension funds and the debt service.
Okay. Answer the questions. State laws were passed years back that says that the county will automatically take the percentage for the police pension board and the fire pension board and deposit them directly into accounts established by the police and fire pension board. So they do not cross the hands of the village. So we don't have to make the transfers. Yes, I go back long enough when I remember the whole bill would come in and then we would have to do the allocations. As far as the debt service levies are concerned, the most recent debt service levies, when they were done in 2009, they required that the money be put into escrow. So that's done at the time the bonds are issued. So now what ends up happening is this money's going into escrow, meaning, again, the county is, when the taxes are coming in, they're taking the proportionate share of those taxes related to the debt service, and they're going into an escrow account. The village still controls the escrow account, but the money sits in there, can't be used for anything else other than making a principal and interest payments on those respective bonds.
Okay, and then the next question is, so last year, in regards to the 14% loss in cost, so my understanding is that the loss in cost is primarily there to ensure that you get what you put in the proposed levy. And so the idea is that you have this loss in cost so that if you miss that big number, you should at least make the number for the proposed levy portion. So the second question would be, what percentage last year of the proposed levy, which I think is about $13 million, what percentage of that amount did they collect for 2018's taxes?
The percentage collected, which I gave to the board, which is in the packet, was just under 79% of the 2018 levy was actually distributed by the county to the village. Whether it went to the pension funds, to the debt service funds, or directly into the control of the village itself. The debt service had a 14%, excuse me, the 2018 levy had a 14% add-on for loss and cost, which was trying to bring it into exactly the way you described it. If we're collecting 86%, we need to charge 14% more to get us to that 100%. So the 14% was added on last year to all of it. But at the end of the day, with the 14%, we collected 78% of the total levy.
So 79% of the $15 million then, correct? Is that what
correct? That would be correct.
So then the question would be, so that's about, if you're just doing that off the cuff, 15 times 80% would be $12 million. So that means you kind of, so my question then becomes, when looking at this year's levy, you're saying that they're doing a 6% loss in cost, and the question I would have is, if you're traditionally only getting 79%, it would seem to put you somewhere behind the 8 ball in terms of being able to collect the amount that you've extended, because it would seem like you'd have a historically, if that is true, then your 6% loss in cost would suggest that you're going to collect about 94%, and so it would automatically mean that unless you collected that amount or somewhere in that ballpark, that you're going to have significantly less monies collected for the tax levy. And my question then becomes, how does the village, knowing that you're going to have that kind of a loss, how will the village be able to kind of create a budget based on the numbers that's given?
A number of good points there. Let me address the first one of them, and that is, when the budget is prepared and when we're working on the budget, we put in what we believe will be the estimated taxes collected, not the full value of the tax levy. So we're compensating for the fact that that total amount won't come in, and then we monitor it throughout the course of the year. That answers one. The second part, I agree with on the math end. If we're only collecting, let's say, 80% now, we should do a 20% loss in costs. Think about what it's going to do to the tax bill. I mean, this is forcing the village, notwithstanding, to watch its cost, because we're not going to, if you add that extra 20%, your tax bills are going to go up exponentially like you saw last year. So it's taking into consideration where there's going to have to be built-in cuts somewhere to be able to make up for those losses, if you follow. The debt service, what I was saying though, with the corporate levy, the 14% was added last year. That's now built in this year. That's the money getting extended, so we're already getting that. Again, though, the debt service, part of that levy is made up for the tort liability to the city of Chicago, so that too, if the money that we levy, the money levied is not sufficient to pay, the corporate fund will make up the difference. I'm basing it on the fact that we can't raise those levies up any higher. They just can't. The logic says yes. If you go back, I've been in this field for 40 years, if you go back 20, 25 years ago, loss and costs out here was 3%. And we were collecting 98, 99%. So you kept it at 3, and it stayed at 3 for decades or longer. And it wasn't until really when 2008 came about and we saw so many people walking away from the property, the values of properties dropped. We all know about it here. This village of Dolton is not on an island unto itself. This really hit hard in the south suburbs. Some of the northern suburbs have recouped, but you could, I read Cranes, and you could still read stories about the rich houses, the $10, $20 million homes are not fetching what they did when they bought them back then either. But for us, with those tax rates going, with the EAVs dropping down and the tax rates going up, we're really caught in a catch-22. If we ask for more money, we make the taxes higher, the tax rates go higher, the taxes are higher. We're going to lose more people not paying taxes. That's inevitable. There are people that just aren't, they're going to walk away. I mean, people who have a solid equity position in their home, maybe not. But those that recently bought their home, maybe FHA, 3% down, VA, 0 down, there's no skin in the game there. If they can't make it, then they just go somewhere else, unfortunately. But that impacts us, the residents that are still here, because you got to make up the difference. That is why when I put this together, I didn't say 14% because I don't think 14% is realistic. It's just going to hurt us. We're going to lose more than we're going to get. And we're going to, when the budget comes around next year, because we know half this levy really is going to be funding next year's budget. By state law, we're passing this levy, and it's compared to the budget that we passed in 19. All right, when we passed it in July, this levy is compared to that budget. But we know from a reality standpoint, our first installment is in March, so, and our fiscal year ends April 30th. So that second installment comes in August, September. That's when we'll get the money. And that's funding next year. That's not funding this year. So the budgets get a lot more complicated than people might think. And when I'm working on them, we're already taking into consideration what's going to come in next year when we're working on next year's budget. Okay, I know I got this levy passed. I know we're going to do another levy. What do I think that levy is going to be? I mean, whether the board approves it or not, I'm still going to try to put those numbers together and then present a reasonable budget that hopefully will at least be break even in the general funds, and try to make sure that we're committing to all of the bills. So there's a lot of moving parts in this. I understand the logic says 20%. I don't think anybody over here would want to see a 20%. That's why when I talked with the trustees on the phone, I said, I think we can do it at 0 for the operating levies. I said, you should do something though for police, fire, and debt service. Otherwise, if you don't want to fine, the debt service is going to make the bill go up 1.2% and leave it at that. But I said, then you're going to short that corporate fund. And that's what and obviously I live out here too, and I know how residents, if there's a crime, the next meeting, everybody wants more police officers on the street. Well, they cost money. They're not cheap to bring on the payroll. So
one more quick thing then, because I think the issue that I guess one of the concerns that I could see happening with that is that it becomes very hard for folks, including the board members, to look at the levy and see how much they have to put in the budget for property taxes. So insofar as you don't want to take that 6.7 million and raise it by 20% or so, because you don't want to extend it that way, why don't you work backwards and say, okay, here's the 6.7 million I want for the total extension and say then what I should be requesting is 6.7 or 6.7 minus the 20%, so that people can then have a more kind of realistic view of what they have in the corporate fund to deal with. Because that would kind of be about 5 million and some change, and that would actually be more along what the board would be working with in the budget, as opposed to saying, here's $6 million that you know won't ever come.
Okay. When you're saying to people, are you saying people being the board or people being the resident?
No, I mean, I'm saying that the board, you know, if you don't feel confident that you're going to get $6 million in the levy, but you want to extend the tax for $6 million, then I would draw the levy down a certain percentage itself, leave the total extension the same, but draw the levy down so people will know that this is really what we're shooting for is $5 million, and then you would budget for $5 million instead of 6, and then that way you have a more realistic view of what the board would have, a more realistic view of the property tax money that they'll have coming in versus a number that may fall short.
If I can, on that one, because
Jason, our trustee House,
yes.
I understand what you're saying, but actually I do it just the opposite way. So when I'm working on the budget, I already know what those levy collections are going to be or have a good idea. So we're operating within the budget constraints. We're not suggesting pass the budget and now we're going to sit down 6 months later and try to figure out what the levy's going to be. The levy is, these levies have been going on for 15, 20 years. Our payroll is set at certain numbers. We can't, unless the village board is going to sit down during the budgetary process and say, okay, we're going to cut 20% of the payroll. I know the payroll where it's going. The collective bargaining agreements tell us what we're going to pay. So by the time we're getting to the levy, that's already been figured out, more or less speaking, because we know what our cash flow needs are. And we know we're not going to collect the $6 million. We have that built in. We know we're going to be, well, actually, we were looking at 85%, so if it comes in at 70, yeah, we'll be 5% short. But we're building the levy, we're building that into consideration, but we started at the budget process because then we already know what the levy, we understand how the levy's going to be shaped. The levy doesn't shape the budget shapes the levy, and we pass the levy first. But I'm using the same philosophy, I'm just doing it in a different way. I don't do the levy first and say, we're only going to get 85%. No, I know we're going to get 85% when I'm doing the budget. So if you look at the estimated revenues, you won't see them equal the levy. The estimated real estate taxes are not at the level of the levy. It's going to be less to take that into consideration. And unless the board sits down and decides, and I don't think they're going to do that, is cut 20% of public safety, then we could make some major adjustments downward on the levy. But if it's going to stay the same, most of the tax dollars, quite honestly, are covering public safety. So that's the reason it's hard to cut the tax dollars. And the debt service is what it is. And the pension funds, you know, I think we can all complain about them, but it is what it is too. It's set by statute, so it's only a portion of this levy we actually control. I'm meaning the board.
So with that being said, we've hit the 2-hour mark on this meeting. So what I'm going to do, if there's anybody who has not asked a question that has a burning question, please feel free, but I'm going to try to abbreviate it. And after that, amongst the board, we're going to discuss the recommendation for the special meeting and move forward with that. Anybody who has not asked any questions, has a burning thought? Okay. Once, twice, third time sold. Thank you, John, for your time. And I gave the thanks earlier. I teased with John, take me off the clock. Okay, yes, I am. Yes. The one question earlier was about that we have the, yes, sir. Is about the position of finance director. What I can say about the position of finance director is we initially intended, we're looking for a finance director. In talking with the mayor, there have been 2 people that I know of, and not to mention anybody that he may have looked at for that position. We have not found the right person for that, given that it has gone on for so long and it is an expense to an alternative thought that was discussed with Mr. Kasparek and the mayor as well, would be that we hire people that we maintain the Kasparek group, but we bring people in office to do some more of the day-to-day routine tasks and such as payrolls, accounts payable, which could reduce the Casparic Group's invoices, but also help the village in terms of cash flow and get some of use them more for their expertise versus their, I don't want to call it data input because it's more involved than that, but it's not something that may require that level of expertise. So that's an area that we've started to look at because of challenges with finding a finance director. The mayor may have more that he wants to expound on that because I know that is his appointment, but in my discussions with him, that's what's happened with the finance manager. Okay. One thing, citizens, we'll do a brief question here in general. Here, I'm going to come to you so we can come here.
Real quick question. Monday's meeting, there was a question asked that was not answered, but it brought about a little bit of curiosity on my part. Ms. Downs asked a question about the funds that, it was an ordinance that was passed. It was 15-018, where the board approved the ordinance to borrow funds from the Public Water Supply Loan Program. Did we actually acquire those funds, do you know? And if we did, are we paying them back? Because it was in the tune of $4,060. There's an ordinance. I looked it up.
When was that passed?
In 2015, I believe.
2015. Okay. So there was the village has made a couple of applications, and Liz, you may be better versed on this than me. If not, I'm sorry for putting you on the spot. But the
ordinance that you're speaking of is with Stan Urban. When he applied for it, there were some mistakes made, and we did not qualify for it. So I'm now going after it again. I don't anticipate that it will be $4 million. We have been computing the amount of meters that have already been installed, so that is going to take away from that $4 million. The deadline for all of the paperwork, which is ginormous, and it involves Public Works, the accounting department, myself, Janice is assisting, Matt. It's a big project. We're anticipating it's going to be a lot less than $4 million, but we're computing that now. The deadline is in January.
So there have been meters installed, but we haven't gotten the money.
Some meters have been installed, but so when contractors come in and people that are doing new development, they put in the new meters. So that will be meters that we won't have to install. Sometimes when people have to get replacement meters, they get those meters. That's minus that. So we had to compute all the meters in the entire village that have already been installed. That was a really big process, and we're still doing that. We also have to go over something called the LMAO2 report that deals with water loss from the city. So there's a lot of different factors that come into play. We're anticipating that we are going to make the mark this time, and we are going to get it. There's a lot of projections that we have to come up with that the Casparic Group is helping us with. And so, yeah, so we're on track, and all the paperwork is due in January. Okay?
And forgive my oversight. Liz is here after hours as always, so thank you for being here.
This question is for Liz. Why are we buying, do we have to have a brand new meter? Okay, the reason I asked is because my mother just went through the transition with their meters to have them, rolled over or whatever you want to do. And they just came in the house. She didn't have to have a new meter. It took them 20 minutes and they were gone. But Dolton is saying we got to buy brand new meters. Now, who's going to pay for these meters?
So that's part of that IEPA loan. And the fact of the matter is there are meters in this village that are older than some of us here. And those meters are not as advanced. One of the issues that we have identified with the water department that I think would help a lot in the consistency was if we had a different type of way to read the meters. Instead of having some people out on foot walking around, actually manually trying to read the meters, also getting cards. Sometimes people send them in 2 days later, so then they end up getting an estimated bill. We get run down with tons of yellow cards, many different factors. I think that if we went to the satellite meters, or the meters that all they have to do is drive down, drive around and pick it up. I don't know what kind of meter she has, but more than likely, if she has the new meters, did she recently get a meter, an outside reader?
Yes, she did.
So that's one of the meters. That's what we're doing. We're changing out all the meters on all the homes, even the older homes. So
you guys are gonna pay for this?
So the ones that aren't already done, those are the ones that we're going to have to pay for, to have twitched. Yes.
Okay, so that being said, I'm going to summarize, as I heard it, the options for the finance committee, and then we'll take a vote, and that'll be the recommendation that will go to our special meeting that has yet to be scheduled, but will be scheduled very soon, because it has to be done before the end of this month. As I hear it, this potential 6% increase in loss and cost taxes would equate to about $182,000. That expense is going to be something that the village is responsible for, whether we vote to increase this or not. Having said that, the options are vote to do the 6% loss in cost increase, or know that on our general fund, when we do our budget, we need to set aside approximately $200,000, because we recognize that there will be a decrease in there will not be enough money on our debt service, so those funds have to come from our operating expense. So my vote is that we set aside the $200,000 from our general fund as we do our budgeting process. That's my vote.
So you're saying the 6% will in fact be the 182,000, correct?
6% is the 304,000 number she did very last number. 182,000 is what I said debt service is going up by.
Okay. So when you first talked about it, says zero operating, so no increase, but it will go in with the 14% that we're already at now.
Correct. It would be a zero increase over the prior year.
Right. And then we're going with the 14%, with the additional 6%, like Sandra said, the 20%, correct?
Well,
The
then if you use that logic, then you can go back from day one. I mean, the levy was extended the levy's extended. We're saying that you're saying as a board, you're not increasing what was extended last year.
Okay.
That's zero.
Right.
Okay. What happened in the past, I mean, we got there by virtue of every year, probably for the last 50 years, increasing the levy. So it's zero. I said the debt service is going to go up 182,000. That is a number that will be extended by the county. That's not to be voted on by you. It's just the operating levies.
Okay.
And so I was just giving a full picture, saying it'll be a 1.2, but you're extending a zero increase. That's what you control on the levy.
Okay.
And that's what you're saying. And then we talked about loss and cost.
Exactly.
The effective increase of doing the pensions and the debt service makes the overall levy 3.09% increase if you do that. If you don't do it, and you don't do any loss and cost, then we're at the 1.2.
Okay.
And then if you decide you don't want to pay the 182,000, see that go up, then we'll lower debt service. We'll lower the operating levy by 182,000 to offset the $182,000 increase. You'll have a zero increase completely. It'll be extended at a zero increase, but you're going to be short in the debt service fund, absolutely. So you will be using dollars out of the general fund to make up that difference.
So anything we short is going to come out the general fund anyway.
True.
Right.
But eventually, if you short general fund, then general fund all of a sudden has problems.
Right. So, I mean, I agree to leave it like it is. That's just me.
So you're saying what Trustee House said, $182,000, that's what we have to make up. That's the difference we have to make up. If we don't do the 6% increase, we have to make up $182,000 approximately. That's what you're saying?
No, those are two different numbers.
They're two different numbers, right? So that's what
182,000 is in debt service. You're not even voting on that because that's going to happen.
So that's going to happen regardless.
Right.
So what are we potentially going to be in debt if we do not raise it to 6%? The loss in cost. What do we potentially have to take out the general fund? How much do you foresee taking out the general fund?
If you want to say it's going to be an absolute zero increase over last year, then you're going to reduce the operating levy by 182,000, and you're not going to extend debt service. So, I mean, you're not going to extend loss and costs, excuse me. Loss and costs will be zero. We'll say no loss and cost extensions. That'll guarantee that will be about 400, at least 400, maybe 500,000 short in debt service. And you've already taken away 182,000 out of the general levy. So you're knocking out about $700,000 of operating funds, real funds that you're using right now to help keep the corporate budget alive.
So that means if we do not pass the 6% increase, we will potentially have to come out of $700,000 out the general fund to make up the difference.
Yes, because you said to reduce the general levy by 182,000 to offset the 182,000 debt service is going up. The 6% loss in costs, I told you, wasn't going to be enough anyway. That's 300,000.
Yeah.
I know you're going to still be using money in the general fund, but you're talking about knocking out almost $500,000 out. So yeah, you'll be closer to 600,000-700,000.
600. So if we
somewhere in there, I can't. It all depends what the ultimate
we have to pull
collections are.
$600 to $700,000 out the general fund if we do not pass the 6% increase.
Yes, and yes.
And from my knowledge of the general fund, if we have to pull out to $600,000 to $700,000 out the general fund, we have to cut somewhere else to pull out $600,000-$700,000.
If you recall, about 3-4 years, it was maybe longer. It actually defaulted on bonds because we didn't have the money available because those debt service levies weren't. The loss and cost was not being extended sufficiently, and the amount of debt you had outstanding when those bonds came due, you didn't have enough money in the corporate fund. So you defaulted on them. The bond insurers came in, paid them. You have since squared up with them, but that will happen if you go with 0% loss and cost, because you're going to, every year, you're going to be taking more and more money out of the corporate fund, not taking into consideration you're increasing your costs in the corporate fund because you're giving pay raises to public safety. So, because that's your payroll per public safety is your largest expense.
Help me clear up one thing, because then my understanding, you're saying 700,000. I don't know where that figure is coming from. I saw the 182,000 and some of the.
Well, that's part of it. You're going to knock the corporate levy down 182,000 to make it a zero, because you're saying if the debt service is going up 182,000 and you want it to be a zero increase, you're going to take 182,000 out of the debt service.
Corporate levy, we started with the understanding we were at zero to begin with.
Okay, well then, if we're starting at that level, then I want it'll stay zero, but the debt service is going up 182,000 because that's the amortization. Oh,
which I understand. That's my 182,000.
All right, that's your 182,000.
Yes. So I don't know where the other 500 came from.
I said we're 300. The debt service extension is 300,000. That's 6%. And 300,000 is not going to be enough anyway. I already know that. You're going to make up some of that in the corporate fund. I can't be exact. I know if you were 40,000 short this last year, and you're not going to do a debt service extension this year, loss and cost, that it's a minimum 40 plus the 300,000 plus I don't know where the collections are going to be at next year, and so I think you're going to be somewhere in that 500,000. Now the other reason I was adding it too is because I thought you were going to reduce the corporate levy by 182. Now, and to make that overall, okay, that part, no, we're going to be somewhere between 350 and 500,000. You got to understand it's going to be somewhere in that range. And when it comes due, it'll come due in December. Well, right at the end of November. So we'll have to make sure we're putting money aside in the debt service to cover that. So every month we've got to really start being aggressive on that.
So as opposed to 200,000, I think we have a great accounting firm that can help guide us through that part. But my vote doesn't change. Thank you for the clarity. So what I'm saying, 200,000, it probably will be closer to 350, 400,000 ish in the general fund for clarity. So that way I'm not misstating, or we're all on the same page. I hope.
I am now. You're saying you don't want to do an extension of loss and cost.
I'm saying I don't want to do an extension of loss.
Then you're correct.
General. Okay. That's still my vote. I don't know if that changes anything for Trustee Brown or Trustee Steve. Well, I'll pass them.
No, we're good. I'm good.
So we have to make up that, if If we don't vote on it, we have to make up that difference, that $300,000-$400,000. And like he said, we being at our accounting firm, you will find a way to make up that difference. But in Kelso, I don't want to, we don't want to cut from public safety. You're right. Unions get raises. Everybody gets raises, yearly raises. So we have to figure something out.
We'll keep an eye on it and advise you accordingly.
My vote is, I say move forward, but I know I'm just by myself. I say move forward with it, but that's me.
So then, as we move forward, so we have 2 for 0% on loss and costs, just loss and costs. Well, operating was already at 0, and 1 say move forward with the increase. So what we'll do when we call the special meeting, the vote will be 0% loss and costs and 0% on the corporate levy. That's what we will be voting on. There are still 3 other members of the board. Should those 3 disagree, they are free to make their vote and change it up or down as they see fit. However, what we will vote on, or what we are asking that the ordinance be drawn up as from the Finance Committee, is 0% for the corporate levy and 0% loss and costs. So that way the taxes the tax level we were at last year will be the same level that we're at this year going forward. All right, with that being said, I'm going to motion that we adjourn.
Second.
All right, Trustee Steve? Aye. Trustee Brown?
Aye.
And Trustee House is aye.